Hello friends and welcome to Cafe Mutual YouTube channel. Friends, small cap have been in the news for quite some time now due to its stellar performance. The category has delivered CAGR of 33% in 3 years, making it most sought after category among investors. Now, the question is whether small cap continue to rally or is it the time to book profit and move to other categories of fund? To answer this pertinent question, today we have with us Ajay Khandelwal, Senior Vice President and Fund Manager Equities at Motilal Oswal Mutual Fund. Ajay has over 18 years of experience in equity research and fund management. So let's hear from him. Welcome, Ajay.
Thanks, Nishant. Thanks for having me.
Okay. So, Ajay, my first question to you is on everyone's minds today. So, small cap funds, as you know, that are the top performers among the last 1 and 3 year period. So why do you think that the rally will continue? And what is your outlook on small cap sectors, especially for the next 3 years?
Right. So I think, Nishant, this question is there in the minds of every investor now.
Right.
How we look at it is that if we have to look at the stock performance, we also should look at the earnings performance. And if stock performance is running ahead of earning performance, then yes, we need to be worried. So if we look at 4 years of earning of Nifty small cap, it is 35%. Last 2 years, because of base, it's even higher at more than 45%. But let's take 4-year base, it is still 35%.
Okay.
So when we look at the stock performance vis-a-vis earning performance, I think that gives a better perspective. So that is about the earning part of it. Because people also want to know whether there are enough opportunities available in small cap or not. So let me tell you in two parts. One is small cap as a category. What are the, again, opportunities available? And secondly, how we are going to look at it.
Okay.
So small cap now as a category where more than 2,000 crore market cap, you have almost 500 plus names available. Where if you look at large cap and mid cap, it's 100 and 150 names available. So it's a wider canvas. It provides you more opportunity to choose from. One is that. Second is, Nishant, in small cap, you have many options to choose from. So if I like a sector, I can have at least 3-4 ancillary plays to choose from. So let's take example of capital goods, for example. Now in large cap, you will have 2-3 large utility companies. You have 2-3 equipment suppliers. In small cap, I have got again wider gamut. I have large transformer companies, turbine companies, compressor, pump manufacturers, equipment suppliers. So even if I like a certain part of market, I have more options to choose from. And the best part is all these businesses now have very healthy balance sheet, because the earlier risk has been about what happens if some problem comes up. Small caps always find it difficult then in that kind of a situation. But now when we look at the balance sheets are fairly good. So in the history, whenever small cap has seen large correction, it is all because of balance sheets. Here, this time, the debt to equity for small cap has come down from 0.7 times to 0.3 times. That tells you that businesses are generating good cash flows and they are able to, fund their growth through their own accrual. So we feel there are a lot of opportunities available in small caps, and also they are getting bigger. Nishant, I think 7-8 years back, the largest small cap was 2,500 crore market cap, which is now 17,500 crore. Almost 6-7x kind of increases happened in the size. So there are much more opportunities to deploy, find new ideas.
Great. But how comfortable are you with the valuation of small cap segment?
Right. So first things first, Nishant, in terms of valuation, see, they are trading at less than 20 times 1 year forward. Now, when we talk about large cap, see, they are better covered. So earning capture is better in large caps. Here in small cap, the earning deviation is much higher compared to the expectation. So that is why you always see that earning revision, upward revision happens faster in small cap. And that is why the multiple expansion and stock performance continues in small cap if they are on the right side of earning cycle. So one is that they are at little less than 20 times. It is not that they are cheap, but if we have to look at small cap, because it is a wider bucket, you have to look at stocks which are, seeing the earnings upgrade cycle versus the ones which are seeing the downgrade cycle. So there's clear difference between the two buckets. We focus on sectors and earnings where we are seeing the earning upgrades. So that distinction also gives us enough pocket of strength to choose from. Also, if you have to look at the overall small cap versus Nifty ratio, see, it is a good ratio to understand how small cap as a universe is compared to the other category. So small cap to Nifty ratio is 0.66 times. At peak, it was 0.9. But, taking the peak is not the right way only, but still we are almost 30% away from the peak that way. So these are some of the ways we look at multiples, and for us, it is more important if we are able to find right set of opportunities at reasonable price.
Yeah. So Ajay, one thing that I'm very curious to understand, that Motilal Oswal has been around for almost 13 years now. But why small cap fund now?
Right. So Nishant, see, every AMC need to develop right skill set. Okay, so now for over a period of time, we have got almost 140 small cap companies under in-house coverage. So now we feel we have enough skill set to come up with a scheme which is best suited for investors, and we also have the right skill set. If you currently look at almost 20% of existing funds are already invested in small cap, and we manage almost 9,000 odd crore in small caps. So we are not new to this space, but now we have enough, coverage of companies under our coverage so that we feel that this is right time for us.
Okay, great. And Ajay, since that there are many companies, many schemes in the small cap category with good track record. So why should MFDs opt for Motilal Oswal Small Cap Fund?
Right. So Nishant, if I have to look at current landscape, how the small cap schemes, normally all of them have long tail portfolio. So you will find between 50 to maybe 200 stocks. Here at Motilal, we are very clear in our head that we want right stocks, good stocks where we have full conviction. So this small cap scheme will run with 30 stock portfolio. I would like to make it clear here that small caps are best managed if we keep an eye on risk. So we will not have high stock allocations. We will have 30 stocks, but ranging from 1.5% to 4.5%. So we'll not have 8-9% kind of allocation in any one of the stock. So you will get a differentiated portfolio which is concentrated, but at the same time diversified enough not to have risk on any one stock or sector that way. So one is that. And secondly, Nishant, I think some of these mutual fund schemes have become too large. So with the AUM that they have, they are not even able to look at opportunities which are, say, 2,000 crore market cap. Because if it is a, say, 20,000 crore market cap fund, just to a 1%, they will have 5 to 10% of the company. So which is not feasible for them. So some of these low market cap opportunities which are neglected by market and where we clearly see alpha. So our universe is from 2,000 crore onwards, but there are so many opportunities because of size. Funds are now not able to participate in a meaningful manner. So that is another reason, I think, why we have a differentiated offering here.
Okay. So another point that I would like to highlight, which is related to your second point. So a few fund houses have restricted flows in their small cap funds, citing liquidity issue. So what is your comment? So is liquidity a problem in small cap segment? What is your view?
So Nishant, as I told, one is size of small cap has become larger over a period of time. So our philosophy is that we should have liquid portfolio where we should be able to liquidate any of our stock holding in certain number of days, trading days, by participating in a certain percentage of volume every day. So we are very clear about it. We want to run a liquid portfolio. And some of these funds, I think, because size has become too large for them, so they may not be able to find right ideas. It is also a function of every AMC, what kind of resource allocation they are doing to find small cap ideas, because small cap ideas require different skill set. So I think some of these factors are leading to some of the AMCs restricting their flows. But I think there are enough opportunities available. So we are pretty confident about it.
Okay. So one thing that I would like to highlight is small cap universe offers exposure to many emerging sectors like defense, e-commerce, and so on. So which are the sectors that the fund will invest in? Will you open to explore these sectors, new sectors?
Right. So Nishant, how we think about it is that which are those growth drivers which will bring earning growth. So when I think of, say, Make in India, now Make in India is helping manufacturing, PLI is also helping it, the import substitution is helping manufacturing. So some of these factors are helping manufacturing, and manufacturing is again is a wide sector. It is, if we look at capital goods, if we look at defense, railways, so many other sectors are impacted by this particular tailwind. So when we think how we construct portfolios, we try to look at what are the growth drivers, what are those themes which will help sectors. So I would say we are bullish on Make in India, we are bullish on financial inclusion, we are looking at healthcare ecosystem, we are looking at urbanization, because these are themes which are structural in nature and there are enough good quality companies available at reasonable price. So we still have not deviated from our philosophy of QGLP framework, where we talk about quality focus, more on quality and growth longevity at a reasonable price. So this whole our philosophy still continues, and that is what I think we will be looking at whenever we think of sector stocks. It has to abide by this philosophy of ours.
So Ajay, one last question. So your fund house has recently revised its fund management philosophy from buy, ride, sit tight to high quality, high growth. So what's the rationale and what will change in the management style?
Right, Ishan. So see, again, this is not a deviation from our philosophy. Our philosophy still remains QGLP. As I explained, sometimes what happens, we have realized that we are talking about growth, quality at a reasonable price. Now, sometimes that upside in our fair valuation is captured in a short period of time. Then we have to reevaluate what are the other growth options the company, the business, the management is coming up with. We do not dilute our filters of return on capital, the cash flow generation, the debt to equity. We are just not diluting on any of that. But it's just that if sometimes those upsides are captured, we want to take advantage of it. And we continue to look at businesses and sectors where growth longevity is there. So instead of changing the philosophy, I think that remains the same. The next $1 trillion theme still remains intact. So our philosophy has not changed. It's just that now we are more nimble and we are that way responding to any. We are trying to capture upside in a better way.
Okay. So with that, we have come to an end to this interesting session. Thank you so much, Ajay, for your valuable time and inputs.
Thanks a lot, Nishant. Thanks for your time.
And finally, I thank each one of you for being such a wonderful audience. Have a great day at work, guys. Bye.